Ian Bremmer is back, along with our panel. Ian, you told us about political risk. Now let's talk about how all of this geopolitical upheaval will affect the markets. Starting in Venezuela, we saw the incredible capability of the U.S. military in taking out Maduro so easily. But the tough part is always the day after the day after. How does this play out for oil, for natural resources, for the U.S.?
6 months of planning into the military rendition of Maduro. Very, very successful. About 6 minutes of planning for the oil CEOs meeting with President Trump in the White House. As you heard from the ExxonMobil CEO, Venezuela is non-investable right now. So it's going to take a long time. They might get a few 100,000 barrels out back to 800,000, 900,000 a day within a few months. But to get back to 3 million, it's going to take probably 10 to 15 years and $100 billion. So this is not a near-term question.
Ian, hi, Rebecca Angarino. I'm our banking reporter here at Barron's. You write about the risks in your report of state capitalism. And, we're seeing that play out with President Trump's pressure on the Fed and Chair Powell. I wonder, how do you expect that to play out under a new Fed chairman? And, will President Trump get what he wants on interest rates?
Decent chance that Jerome Powell actually decides to stay on the board now for until the end of 2028. Even though normally he'd be expected to step down and not afford Trump the ability to put another person on the board, precisely because he's particularly outspoken and angry about the efforts to undermine the independence of the Fed. You've heard from Jamie Dimon, someone who hasn't been very vocal about much of what Trump has done, but really was critical of the idea of it undermining the independence of the Fed. The markets would throw up all over it. Secretary of Treasury Scott Bessent as well, privately, telling Trump this is really a bad idea. I think there are a lot of constraints on Fed independence that, frankly, you don't see on lots of other areas where Trump is trying to take more control as the president.
Hi, Ian. It's Elizabeth O'Brien here. Segueing over to AI, you've written that AI is priced for revolution, not evolution. Can it live up to the hype? And if so, is it going to take longer than investors expect to reap real productivity gains and possible job losses?
I am seeing that the use cases for AI are much, much faster moving for the tech companies themselves than for the companies that are downstream that are supposed to be paying for a lot of this and productizing it. So more of a K-shaped economy from the corporate perspective. Right now, we have 7 U.S. companies that are driving a majority of American growth. It looks like that's likely to continue. And I do worry what that's going to mean for unemployment numbers, for consumption numbers, when so much of consumption is among a very small number of Americans. You need to have these people continue to feel confident about the entire economy, not just a small piece of it. So I do think there's greater vulnerability there. But I'm a big believer in what AI is ultimately going to do for the U.S. economy and the world, no question there.
Ian, this is Ben Levison. You can't really talk about AI without talking about electricity, and China really seems to have a pretty big lead in the electric ecosystem, EVs, renewable energy, and whatnot. How big a risk is this for the U.S.?
I think it's one of the stupidest things the United States is actually doing long term. It's incredible that the U.S. is at 14 million barrels a day of oil today, might get to 16 million by the end of the year, radically outshooting what the Saudis or the Russians do. But the Americans are ceding control of post-carbon energies, which are going to cost a lot less, given new technologies, to the Chinese. They're the ones doing solar and wind and nuclear and the battery technology and all the critical minerals and rare earths and the supply chain and reprocessing that allow it to happen. And if you're going to be an electrostate, that energy is a lot cheaper, you're not going to see the political backlash that the Americans are already starting to see against data centers. This is going to get much more challenging. So why cede leadership to the Chinese on a big part of the global energy set?
Ian, we're almost out of time. About 30 seconds left to explain another risk that you cite, which is even though the Chinese are doing really well in electric, they've got a deflationary spiral problem that you say is only getting worse.
It's only risk number 7 because we think they can kick the can. But kicking the can does mean exporting their problems to other countries. They've had 10 now quarters of deflation. And that's meant the only thing that's really working for their economy is manufacturing export, 1.2 trillion in export surplus in 2025. That number probably goes up in 2026. And a lot of other countries are going to be unhappy about it.
Maybe it'll help the Fed. Great. Thanks very much, Ian. Appreciate it.
Good to see you guys.